In Cresco, we are an upcoming synthetic asset protocol trying to bring real-world assets on chain. So today's talk is about going into synthetic assets, just trying to understand what is this asset class. It has been in an integral part of DeFi from quite some time now, but like other sectors like DEXs or lending protocols, it hasn't really taken off. So we'll look into its history, we'll look into the major players in this space, and then also I'll explain how Cresco is shifting the current dynamics of synthetic assets. So before I go into synthetic assets, does anyone have an idea like what do synthetic assets mean in context of DeFi? Okay, yeah. So just to explain in a simple way, synthetic assets are like any assets that you can get exposure of, which they represent, without holding it. So imagine you want to get exposure in Tesla stock, but you don't want to actually buy the Tesla stock. You want to get the benefit of the price exposure without holding it. So how do we do it on chain is currently we use oracles, and through oracles we get the price feed of these assets, and then through a CDP model these assets are minted, and when these assets are minted, they use oracles to track the price of the assets that they represent. So right now in DeFi there are three main categories of synthetic assets. So one is the first one, which is the most popular, is crypto synths. So representing any crypto token in a synthetic version. The best example for it could be, say, Synthetics protocol, if you're aware of. Like, so Synthetics is right now the biggest synthetic asset protocol, and it offers a variety of crypto synths like Cardano synth. So anyone who wants to, say, get exposure to Cardano, but then they don't want to get into the payment rails of Cardano because Cardano is not an ERC20 network, and if a user who is just an ERC20 network user, they want to get exposure into it, they can go to Synthetics and then they can mint as Cardano, which is a synthetic version of Cardano. So just like Cardano, there are these multiple types of crypto synthetic assets. So this is right now the biggest category for synthetic assets, and then we have RWS synths, so representing stocks, commodities on chain. So this is where Cresco we are targeting, because right now, although this is, we can say, the least under-tapped sector of synthetic assets, because you are trying to bring real-world assets on chain, which has itself its own different challenges. So this sector is yet to take off. But this is what we are targeting. And then we have synthetic contracts. So these are not really assets, but in a way they are like virtual contracts. So if you have ever done perpetual trading, right? Like, so you take leverage and then you create a position, and then your P&L account is representing that virtual position. So in a way, you are not, when you open a perpetual position, you don't have any token in your wallet. It's just a virtual position. So in a way, you can't do anything much with it. Like, you can just track your P&L, and then depending on when you want to close the position, or if you get liquidated, your position closes, but you don't actually hold a token in your wallet. So as I explained earlier, that right now the biggest untapped sector for synthetic assets is RWS synths, and let's look into the reasons why. Like, what's the reason why RWS synths could be really big in DeFi, and what actual use case that they are solving. So to understand that, we have to look into our current financial system. So right now, if you see the current financial markets, they are highly restricted, right? So if imagine if you live in a country like Nigeria, and you want to invest in high quality assets, like say you want to invest in S&P 500 index, it's really difficult because you have so many regulations, you have so many geographical barriers that for an average person living in these countries, they don't have access to these assets. And if you look at the performance of the assets all over the world and the assets just in the US and other high-income countries, you will see these assets nearly outperform the global assets. Like there's a chart showing the asset performance of US stock market and the global stock market, and you can see in the last 10 years, US stock market has increased by 186%, but in contrast, the global stock market has only increased by 50%. So we can say that people who are not living in the US or people who don't have access to these US stocks, they don't have such high quality options that people living in these countries have. So this is one problem that we could solve by bringing these real world assets in form of synthetic assets on chain. Secondly, in addition to this issue, like we have even when you get access to these synthetic assets, to these stocks and commodities, you have other issues. Like you have this issue of centralization. Like we all saw what happened in 2021 with the GameStop saga, when a bunch of traders on Reddit, they started going short against the hedge funds on GME. These hedge funds ordered Robinhood to not let these retail traders close their position. So right now in our current financial system, these central entities, they hold our power. They can block any users they want. They have absolute control over your funds. So the only way to escape this is to have these assets enabled on blockchain. So now we know the importance of these synthetic assets. Let's look into the timeline of these synthetic assets, like how it all started. So it started in 2017 with the creation of CDP model, collateral deposition model, which MakerDAO pioneered it to create the first lending protocol. But then this similar concept later on proved to be like the de facto model of most synthetic asset protocols, starting in 2018 with Synthetics. So Synthetics was not actually a synthetic asset protocol, but it pivoted to being a synthetic asset protocol, and it utilized this collateral deposition model to become the first synthetic asset protocol. And it started with currencies. So it started with SUSD, which is till date its biggest synthetic asset in terms of TPL. And then in 2020, when the DeFi summer came, like when all these different DeFi protocols and categories took off, similar spillover effect came to synthetic assets as well, where in addition to synthetics, we saw like a slew of new synthetic asset protocols coming up, like Miller protocol and DeFi chain. And during this period, synthetic assets as a category, it went over 2.5 billion in TPL, with both synthetics and Miller protocol getting over 1 billion in TPL. And from this peak, it all started going downhill when in 2022, in May 2022, Terra collapse happened. And because Miller protocol, it utilized UST, which was the main stablecoin of Terra, it also collapsed. So at that point in time, Miller was the biggest synthetic asset protocol for real world sense, because in 2022 synthetics also phased out real world assets. So because of less demand and regulatory challenges, synthetics decided to do away with these assets. And after this point, there was this huge dearth of lack of RWA synths in the space. And then now, like this year, we are seeing the rise of synthetic assets again, like particularly RWA assets. And for this new generation of synthetic assets, Fresco is leading it, and I'll come to it later, like how we are doing it. But then right now there are new type of synthetic asset protocols that are solving the existing problems of the first generation synthetic asset protocols like capital efficiency and the UI UX issues. So let's look into the performance and traction of synthetic assets. So here is the timeline from DeFi Llama. As you can see as we saw here in the timeline that from 2018 when synthetic started was a sole synthetic asset protocol, but then after and then it was all quiet until the bull market started again in 2020, and then you can see that during the mid of 2022 there is this terror collapse which resulted in a significant loss of TVL across the board, and since then the sector has stayed the same, like there hasn't been any big upsurge in TVL, but then with new synthetic asset protocols coming up and the market conditions improving, we might see it go up again. And here's a look at the adoption part of the synthetic assets. So this data is until last year, October 2022, and if you see, like although in terms of TVL, there was a decline in decline of synthetic assets, but then if you look at the number of transactions, it is still growing. Like people are still interested in this asset category. Like if you see the data collapse happened in April 2022, the TVL decreased, but then the number of transactions they have stayed the same. Similar trend can be observed in the volume as well. Like unlike TVL, it hasn't really tapered off, like it is still doing well. And then if you look at average volume per transaction, so it kind of indicates that although the TVL is decreasing, but then the number of transactions are increasing, and it shows in that average volume per transactions where because even though the number of transactions are increasing, the average volume per transactions are on a downward trend because people are not taking bigger position sizes in these assets. So that has been on a decrease since that bear crash happened. And then here's a look at three major types of synthetic assets. So right now, in the last 1 year or so, synthetic stables have been still the most traded synthetic assets. So these synthetic stables could be the SUSD, synthetic SUSD, or synthetic currencies like SEuro. So right now these are the safest synthetic assets to trade. So that also reflects in their user adoption. And then they are called like synth cryptos, which I just give example like using these different other cryptocurrencies that are not available on ERC20 networks, and then create a synthetic version of it. So that also has been on the rise. And then synthetic stocks. This is, as you see, in terms of volume, they are much less. Like from the chart, it looks like that they are just about 5 to 10% of the total volume of synthetic stable and synthetic crypto. So this is the category which has, as I explained earlier, has the highest room for growth. And in the chart as well, as I have explained, that Terra was the biggest category of these RWSNs, and we see that like in after April 2022, there's like a big decline in the volume of these assets. So let's look into why, what are the current problems of the existing synthetic asset protocols. So firstly is the UI and UX. So right now, the current synthetic protocols like Synthetics and Mirror, they had a very complicated user interface, which for an average user doesn't make sense. Like anyone who might be DeFi savvy, for them they might be able to use it, but for most of the users, it's very difficult for them to get an understanding of their risk that's associated with the protocol and with their position. And also with this bad UI and bad risk comes the risk management part. Like if you look at Synthetics, which is right now the biggest synthetic asset protocol. If you want to use it, like if you want to mint a synthetic asset, you have to use SNX as a collateral. And what SNX is not like a stable collateral, it's a volatile asset. So when you use SNX as collateral, your collateral ratio always keeps fluctuating, and you always have to worry about it. And because SNX is a volatile collateral, your collateral ratio is also much higher, which brings me to my next point, which is capital efficiency. Like right now, the current synthetic asset protocols are not capital efficient. Like with synthetics, you have a collateral ratio of 500% right now. So that means for every $100 you deposit, you are able to mint synthetic assets worth of only $20. So which makes it like highly capital efficient. Even with mirror protocol, it had the same issues. Like when it was live, it had a collateral ratio of 200%, but then it had even bigger issue of just using USD as collateral. So both mirror and synthetics, they have this single collateral system where they are only using one asset as collateral. So imagine in worst case, like even with synthetics, it has a risk, like where imagine if something happens to like the SNX token, some smart contract exploit happens with synthetics, and because SNX is synthetics token and it's directly correlated with the security of the protocol, what will happen is even if the exploit is not directly related with the positions of the users, because SNX token will drop in price, it will start a cascading effect of liquidations on the protocol. So this is some issue which so far no protocol has fixed it. The new protocols that are coming up, they are also having the single collateral system, and they are exposed to this same risk. And like if you look at like right now these four protocols that I was talking about, even DeFi chain. So DeFi chain is not exactly a protocol, like they are a Bitcoin folk trying to bring smart contract compatibility to Bitcoin, but then they started minting synthetic assets back in 2021, but it has its own issues, like these synthetic assets, they are not composable, like which is the biggest property of DeFi. Like if you have any synthetic assets, you want to use them in different protocols. But the DeFi chain, if you have any synthetic asset, it's only usable on the DeFi chain itself. And if you look at the activity going on in DeFi chain right now, there are many protocols. So you can't do much with the synthetic assets there. And then you have Gains Trade, which is an example of synthetic contracts that I was referring earlier. Like Gains is a derivative protocol that offers perpetuals, but like about 1 year ago, they offered perpetuals for gold, for stocks, like for everything. But then the problem was you could only take leverage and have these synthetic contracts, but not actually hold these stocks. Like say someone who is a value investor, like and they want to hold these stocks, they can't, because you don't get a token in your wallet. You only have this perpetual position that you need to maintain by paying funding rate. So that is an issue with Gain. And then the mirror protocol and synthetics, I just explained. So now how Trestro is coming into picture. So there are like three major factors that differ us from the existing synthetic asset protocols. So first of all is the user interface, of course. So this is like a screenshot from our Defi app that we had back in March. So we have tried to make the user experience like as simple as possible, as straightforward as possible. Like this is the home page, like where everything is like whatever position that user have is visible there. Like so to simplify the user experience, to give user a clear idea of their risk of their position, and then secondly, our focus is on the risk management part. Like so, I just explained you about the problem of single collateral, and then there is another issue of like with synthetics and the mirror as well. Like where first of all you have the single collateral, and then you can't have like a shared collateral. Like imagine if you want to open multiple synthetic asset positions, like you want to mint say synthetic Tesla, you want to mint synthetic Apple, you need to have separate collaterals for these different positions. So then what happens is, say you have 4 stocks, you have limited 4 stocks, then you need to open these 4 different, you deposit these 4 different collaterals, you have these 4 different collateral ratios, and then you have to manage all these 4 collateral ratios. But what we are doing is we are offering a shared collateral system where you deposit just one collateral, like say you deposit 1,000 USDT, and you only worry about your overall collateral ratio. Like say the collateral ratio to maintain is 150%, and then it's up to you, like how many positions you want to open using the collateral you are free. Like you can open 10 positions, you can open 15 positions, you can open as many positions you want. Only thing you need to worry is your collateral ratio, your single collateral ratio. So it simplifies the risk management for users. They don't have to worry about these different collaterals. And then we are supporting multiple collaterals. Like so, you could deposit rapidly. You could deposit rapidly. So you could deposit any whitelisted assets. Like so, we'll have like 7 to 8 whitelisted assets initially, which you could use it to then use any of those collaterals to deposit and open these synthetic asset positions. And then thirdly, this is more of like a long-term goal. You want to have a Web2 experience, like in terms of interface, and not on the back end. The back end should be Web3, but the interface should be Web2. Right? When you're using any Web2 application, right? When you use Revolut, when you use like these fintech apps, you only see the front end, right? Like you don't know which server they're running on, and I think that should be the goal of the industry itself. Like people shouldn't have to think that okay, this project is on this chain, this project is they have this collateral provider. A user shouldn't care about these things. A user should just only care about the problem that the project is solving. So that's our end goal, like to do away with all these complexities like of Web3 and then make it as simple as possible for the user. And here is like the key points. Like if we compare Fresco with TradeFi solutions, so imagine if you use Fresco to acquire a stock or like any commodity versus you use a brokerage account like eToro or interactive brokerages. And so what are the main differences? Like so first of all, if in transaction fees, like all three, and this tokenized security is I'm comparing the RWA protocols. So right now you see these bunch of new RWA protocols that are tokenizing these assets on chain by actually following all these regulations. So if you compare all three, you see the advantages that we bring. We bring majorly the advantages in fast settlement. So all these stocks that you acquire, they are settled instantly. Like with traditional brokerages, you might have to wait longer. And then hours of operation, like right now, if you see the traditional markets that you can only trade between 9 to 5 p.m., 9 to 4 p.m. But with Fresco, you can trade 24 to 7. And then a transparent business model, which is because everything is on chain, so you know what is going on behind the scenes. And then the censorship resistant part, where no matter what is your location, you can always access the platform. And then the capital efficiency and the global liquidity, where you could access any real assets, irrespective of where it is based. It could be a UK stock, it could be a US stock, it could be any asset, it doesn't matter. The only drawback is dividends, right? Because you're not actually holding these assets, so you're not going to get any dividends of the stocks or stocks that you hold. So that's the only downside. But I think in the modern age, most people, especially for growth stocks, like tech stocks, most people don't care about dividends, they only want the price exposure. And this is a summary of how we compare with other synthetic asset protocols. I think I've touched upon all the points already, so I'll just move on. So now just a brief overview of what we are up to. Like, so this March and this year, this March we did a testnet competition that was on Optimism body. It was a 6-week testnet competition. It was pretty successful. Like, we onboarded over 20,000 users across these 6 weeks from 96 countries, and these users they did over 2 million transactions on the app. And that during that period, we were responsible for 80% of the volume that was generated on Optimism body testnet, and these users maintained over 93 million worth of synthetic assets, as well as we had a lot of people doing liquidations. So we have like over 78,000 liquidations, and then if you look at like our top countries, so right now you can see most of them are developing countries like Indonesia, Turkey, India, Germany, Russia, Ukraine. Germany is an exception, but yeah, of course, except that you see most of them are middle-income countries where people don't have such easy access to these real assets. So just looking into challenges like for this sector. So particularly for synthetic like RWS, there are like these 3 major challenges. Like, so first is regulations, of course. Like if you're trying to bring stocks, then you will always be like watched by SEC because stocks are securities. So that is right now I'd say the biggest challenge for synthetic asset protocols. Like where they want to provide these assets, but then how do they provide without violating like any of these regulations? So right now most of the protocols that they are trying to do it, I would say the standard way is like to geo-block the US, like not offer your product in the US, and then also separate your entity, like so separate your entity from like any US-based like entity have like everything which don't have like these regulations regarding securities. But I feel regulation is a barrier, is only a short-term barrier, because like from what I see the future is in next I would say 5 to 10 years when this space matures, there would be some sort of form of regulation for DeFi. Like I believe that DeFi, like right now, most people think of 2 extremes. Like people who promote traditional finance, they think only traditional finance is like the best, crypto is like dangerous, crypto is scam. While most crypto natives they think like traditional finance is like a scam, like it is unfair. But going forward, I think we will have a system which is best of both worlds, where we take the best parts of traditional finance, we take the best parts of DeFi, and then create this one system which is the best of both worlds. So I see going forward, most of the DeFi protocols they would fall like under some sort of regulations. So yeah, like this is only a short-term problem. And then on technical side, there are these 2 issues where, because most of the synthetic asset protocols they use oracles, like they are heavily reliant on oracles for getting the price speed of these assets. So there's always this risk of oracle manipulation and economic attacks. And if we see like in the last 2 years what were like the major sources of exploits, like of hacks in the space, it has been through oracles. So I would say oracles always leave protocols at some form of vulnerability. And right now, we still have a long way as an industry to counter these challenges, like to try to improve the security and try to even create a compensation mechanism for users in case the security exploit happens. Like we have seriously considered these issues. So because of this, we are also planning to have like a safety module. Like in worst case, like we'll make sure we do like we have already done a couple of audits. We'll make sure we are on our best on security front. But worst case, like if there is still an exploit that happens, we have like some sort of backup, like some treasury savings factor cover up for the users and the protocol. And like smart contract experts again, like any this is a challenge which is sector agnostic. Like doesn't specifically relates to a particular sector. Like it is for any DeFi protocol where, as I explained earlier, like any DeFi protocol is prone to smart contract exploit. Like so, the same, I would say the same solution goes for this event as well, where we make sure we have like a backup. As we make sure we do all the audits, we make sure we like communicate on security front, and then as a backup we have like enough treasury to cover in case something happens. So yeah, what was next? So we finished our course beta. We had we finished our testnet. So we had like as I explained earlier, it was a big success, but we realized there were some issues regarding the capital efficiency of the protocol. So we decided to make some changes in the architecture. So the last 4 or 5 months we have been like, busy in that. Like we have been introducing a new architecture for it. Like the new architecture that we will implement would offer users zero slippage swaps, as well as offer users an option to provide liquidity in stable coins. So this is the model we are working on. It's almost ready, and now we plan to have a closed beta live on in December. And yeah, like so this is this QR code for you if you want to get notified about our closed beta. Like we already have over 30,000 people who have subscribed for the wait list. So yeah, like we are looking forward for you guys to join us, like to make that accessible to anyone, anywhere. Yeah, thank you.
Give us an idea of how many your team and staff will be.
Sure, yeah.
How many your team at Fresco is?
Yeah, so we are a team of 7, for a small team, and yeah, we are distributed globally, so we don't have any specific place where team is concentrated, and everyone works from different locations.
And when did you start?
Yeah, so Crespo started, we have been building from quite some time. Like, so we started at the end of 2021. So because it's a novel protocol, like we are not core of any protocol, we have been like building everything from scratch. So it has been taking some like time. Like we yeah, we finished our we did our testnet in March, and then yeah, required some changes. So it has been now over 2 years that we are building, but now I think we have reached a point where we are confident that we have what we wanted.
Any other question? Well, I have a question. So you were talking about capital efficiency. So what kind of collateral do you allow? Do you allow some gate-driven collateral? Because that could more or less speak to capital efficiency issue.
So you mean what kind of
Like SDI, CTF, technology.
Yeah.
Gate-driven collateral. So this way, even if you need to be over-collateralized, well, it's not really a problem because your opportunity cost is low because your collateral is already gate-driven.
Okay, so you are saying that if you use stable collateral, like
If you stable collateral, well, it's going to be very hard to beat inflation. But if you die, compared to SDI, you already lose 5 to 10% per year, compared to using SDI or using SDI bundle or whatever. So what I'm scared, and what I think is maybe one of the reasons that it's pretty hard to get collateral, that this collateral has an opportunity cost. But now, if you have gate-driven collateral, so collateral is already getting a yield from something else, like staking, if it's stake ETH, or like the DSR, if it's DAI, or any like combination of different protocols, then you can more or less fix your collateral issue, because even if you are having 200%, I don't really care, because that's money which is already getting a yield anyway, right?
yeah, I mean we do plan to have like different types of collaterals. We might thought, right, like we could later on when like initially we want to keep things simple, we want to make sure the model is successful, right? Like we want to then try with like simple collaterals like DAI or USDC, but then later on when we are confident of the model, we can then bring in these additional collateral types, like you mentioned, really like yield bearing token, even using your Uniswap LP position as collateral. Like we could innovate that on that part. And I feel innovation. You said about the opportunity cost. Right? I feel opportunity cost shouldn't be an issue, like because the kind of people that will be minting these assets, they will be mainly traders who would take these positions for like short term. Like for anyone who is say, because when you are minting an asset, minting synthetic assets, you are technically going short, like on like the asset you minted. So you can create these different trading strategies, which I feel usually only who are actively trading in the space will do it. For anyone who is planning to get long-term exposure in these synthetic assets, what they can do is instead of minting, they can directly swap. Like they can within the protocol itself, they can say if they have ETH, they can just swap them with these synthetic assets. So like the opportunity cost issue would really impact given the kind of users that we're targeting for it makes sense.